Okay, let's talk markets. Pankaj Tibrewal, founder and CEO with the Ikagai Asset Management, joins us. Pankaj bhai, always good to have you on ET Now. Thank you for joining us. What a summer it's turning out to be. Uh, First, there were only cloudy skies in the month of April, and now the sun is shining bright. Have we seen two extremes between April and May now? And do you think somewhere we'll settle in between?
Good morning, Nikunj bhai. I think if you remember our last conversation in April when everything was looking murkier, I said that the top-down macro is started to improve and macros have bottomed out and incrementally things are looking better. And what were those things? One, oil prices coming down. And don't forget, every $10 barrel of oil decline is 30 to 40 basis points of GDP incremental growth. Second was that cost of funds uh, and liquidity, both this year will be much better than last year. And we have seen how RBI has pivoted itself from a deficit of 3.5 lakh crores in system last January to now a surplus of about 1.5 lakh crores. So clearly, this kind of a pivoting in by RBI, I have not seen X of GFC and COVID. So all credit to RBI for doing this. And cost of funds, you have seen 50 basis points of decline and more to follow in the next 12 months. The third most important point is that the flow side, and as we speak to more large asset allocators who are not bothered about weekly, monthly fluctuations, they are getting concerned by their investments in US. And incrementally, we sense after speaking to them that they want to diversify a part of their US exposure to the rest of the world. Obviously, they don't have a strong handle on India, so they are speaking to us, learning about it. But my view still remains that we will be positively surprised on the flow side which comes to India in this calendar year. And yesterday you saw how $500 million in cash market and another, $500 million to 1 billion in futures can move the market so violently within a very short span of time. So that's the power of flows. And I think I'm very positive and optimist on the FI flows going into the rest of the year. Looking at the micro, I think after a 3-quarter earnings estimate being cut very sharply, we have seen very decent breadth of earnings this time being reported. According to us, 75% of the earnings reported were either in line or beat the estimate. Normally, this number is about between 60 to 65%. And just to give you some number, 316 companies out of Nifty 500 companies have reported till yesterday. And the earnings reported PAT growth is about 10%, which is double digit, which is in my view not bad. And actually, it's an acceleration of the last 3 quarters. Finally, money will follow where there is earnings growth. And our sense is that the first half setup is also looking very good because the base last year was quite low because in the first half nothing happened. And last but not the least, I think capex and consumption this year will be incrementally better than last year. And the operating word, Nikunj bhai, is better, not amazing. So when you look at all these factors, I think markets have found a flow. However, one thing which is a little disturbing is that last 2 quarters, the divergence between the index return and the median return of the index has been very, very high. So just to give you some numbers, in the 4th quarter, which is January to March quarter, NSE 500 declined by about 4.5%, but the median return of the index was negative 11%, which means 7% kind of a divergence is huge. And it means that few stocks in the index heavyweights are keeping the index higher, but the breadth of the market has been extremely narrow. And this, I think, is something of a worry where we rewind back ourselves to 2018-19, where few stocks were holding on to the index, but the breadth was very bad and markets, most of the people were complaining that their portfolio values are not going up in line with the index. So just keep that in mind. And however, I believe there will be a stock pickers market over the next 12 months. Individual stock will make you money rather than taking a broader call on any sector or market per se.
An example of where you think the market is undermining earnings recovery, and give me an example where earnings are visible but P expansion could happen.
So I believe that, for example, chemicals, for example, we have been positive for a while now. I think the restocking on agri side globally has been very, very strong. And I think with the lag, it will reflect on most of the chemical companies in India. Inquiries have meaningfully picked up post the tariff issues. And most of the agro and pharma majors know that they need to diversify a bit of their manufacturing and sourcing out of China. And that, if you speak to most of the chemical companies, they are seeing that inquiries are very, very high. How much that translates into businesses, we'll come to know over a period of time. But inquiries have picked up meaningfully. I think on the consumption side also, things have started to come back. Few of the companies who reported on consumer discretionary space, we have seen very strong volume growth as well as margin expansion. That means that still the tax rate cuts started in April, but the momentum has started to get built across the consumer discretionary. And I think second half of this fiscal year could be a space where consumer discretionary can start surprising us, whether it be retailing, whether it be how consumer durables, kitchen appliances, and so on and so forth. I think these all sectors are trading at much lower P than they used to previously because growth had slowed down. And if growth comes back, I think markets can give them slightly higher multiples. And last but not the least, auto ancillaries. I think many of the auto ancillaries, Nikunj, are transiting and pivoting themselves from being a pure auto to non-auto, which will be about 30 to 40% of their business in next 3 to 5 years. And that's a very, very meaningful change. And whenever that happens, I think the P multiples will see expansion. And I visited personally many of the factories, and I'm surprised to see that how on the precision engineering side, many of these auto and companies are pivoting themselves to aerospace, defense, and semiconductor. And I believe that that's a real opportunity for India over the next 3 to 5 years. So I think you need to go bottom up, do hard work right now, select good promoters, management teams with good balance sheet. I think now the sky is open for Indian entrepreneurs. If they can execute, they can grow very fast and they can surprise the street.
Interesting that you say that, Pankaj, that there is still value on the table. And you just fleetingly mentioned some of those homegrown companies looking at defense. And defense really seems to be, the flavor right now, especially since the unfortunate incidents on the line of control. But tell me, are you looking at defense as a pack in a new light now? That it needs to be part of your core portfolio?
Obviously, defense is a good space to be in. But don't forget that valuations today are prohibitive. Most of the defense companies, you are paying about 8 to 10 times price to sales. Forget about P, but they are paying 8 to 10 times price to sales. So we need to be cognizant of the fact that, yes, there is business momentum. And there is a hope that in the next year budget, looking at the current events, the allocation to this sector will meaningfully go up. And some of the defense products the world has appreciated and they are lying. So export opportunity becomes larger. But the valuation itself is factoring in a lot of these hopes and optimism. So if the valuations cool down for whatever reasons, and it happened post-elections, if you remember, post-June, there was still a lot of optimism and stocks corrected by 40 to 50%. If the similar situation happens because of any other reasons, we'll be looking at it with an open mind. But right now, valuations are prohibitive for us to take incremental calls.
All right. Hi, Pankaj. Good morning. This is Shrishti also joining in. While you did talk about a couple of sectors within the consumption as well as specialty chemical plays that are looking good, but the last time you connected, you did share some of the other sectors like cement, consumer durables, cap goods, and even banking. And add to that list was metals. Give us some sense that any of the sectors do you believe that still presents an headroom for the investors to put in some money and earn out of that?
Yes, hi. On the cement side, we have been extremely positive. And we believe that this year, at least in the first half, the cement sector will report very strong numbers. One, because of the low base, and second, because structurally the margins have now started to come back. And I think the region to play out there is South India. I think incremental delta change will be very, very high in South cement manufacturers because the price hike which has happened in April has sustained itself. And the follow-up price hike could happen in May and June as per our dealer checks. So I think cement, and especially the South Indian cement players, looks to be in a very sweet spot from a delta and incremental change perspective. The second big contra call which we discussed last time was metals. And we have seen a very sharp move up from the recent lows. I still maintain my view that metals is something which we need to have a positive view on. And the simple reason is that if you look at the last 25 years, metal is one sector where it is back to 2002-3 in terms of contribution to the overall profit pool of corporate India. And I think if that happens, there is always a mean reversion which takes place. That was the reason in September of last year we went overweight on cement. And this is the reason we are started taking positions on metals in India because 2001 to contribution back to that level, I think is a very, very decent space and a good margin of safety to have. So we have pure ferrous as well as some of the second derivatives of metals like pipe companies in our portfolio. And we believe that's a good way to play over the next 12 to 18 months. And earnings growth in this sector will optically look very, very high. So these are the other two areas. And obviously on consumption, we covered about the consumer durable, retailing, some of the footwear stocks looking good. So I think broadly the overall consumer discretionary package, in my view, the second half of FY26 will see very strong bump up out there.
Good having you on the show. Thanks, as always, for joining in with your thoughts.